So a theme we're going to have in this lesson is our macro swings, which is our high time frame, will be in red. And our micro swings, which is our lower time frame swings, will be in black. So let's say on the higher time frame, price made a swing high and gave you a macro supply zone. So now on the lower time frames, as price is approaching this range, will form newer swings, multiple micro swings. So now once price approaches our supply zone, price will go into a reversal point, which is your consolidation before reversing. So let's look at this example. Here you have an expansive breakup structure. So what does that mean? That means this is a support and resistance structure. So what that means is price will retrace back into a support zone. So price reacts from a support zone and continues the structure. So now what are we looking at next? We're looking at the next level of support. So now when you go on your micro, which is your lower time frame, you'll see consecutive swings. Price will form your reversal point and expand. So let's take a look at this example. So what do we have here? We have a swing to the high, so an external cleanup, and a breakup structure. So this is what we basically have. So let's mark that up. Here we have a micro breakup structure. So now, are we ready to make any assumptions of the market? Are we ready to understand where the market is trying to go? Not really. Our next step is to go to the macro. So currently we're in the 4-hour. So now let's go to the 12-hour. And we could even go on the daily. So what do we have here? We have a macro breakup structure. And let's lock in our range. So this is our range high and this is our range low. And here is our macro breakup structure. This is our macro breakup structure to the upside. So what do we anticipate from price? We anticipate for price to come back inside of the range and to continue where to our discounted zone. So now let's mark up our fib, just how I explained in part 1. This will be your premium and this will be your discount. So now you mark up your discounted zone. So now this is your discounted zone. So now let's go back on the micro. And what do we expect to see? Like we said, when dealing with two different time frames, which is your micro and your macro, you expect microstructure to be built here. You more than likely expect a pullback back inside of this micro range, which would be this low once price comes back inside of the range, and this high, price come back to an extreme here and continue a bearish structure all the way up to here, and then price can switch direction. Why can price switch direction? Because this is what you are anticipating on the macro. On the macro, what you're looking for is something like this. Now you have your pullback back inside of the range. Price reacted from an extreme. Extreme what in this case? Extreme premium. And where's the next destination? Back to discount. And you do expect turbulence somewhere around the fair price. So this is your fair value, which is your fair price turbulence. And that turbulence gave you a pullback back to the upside, trying to trick you into taking a buy position now. And where is your danger zone? Your danger zone would be the same process you did initially with your zone. So your danger zone would be the extreme. So price could always reverse right here and completely change trend. Why? Because this is the extreme of the range. Before you proceed, please make sure you like the video and leave a comment. This will help us continue giving out these free lessons and potentially a part 3. So let's talk about inducement. What is inducement? Inducement is an act of liquidity being engineered around the area of where price actually wants to go. Prior to approaching the zone or the level where price is intended to go and transact orders, it needs to make a few stops, which are in form of inducing traders to make a mistake and force an early entry. Price will react from a level or zone nearby the intended level or zone to entice traders into taking positions. So this is the level institutions intend to sell at. So as you can see, as price gets closer to the level, it'll give you a fake reversal point. You can see price will consolidate, and what does that consolidation do? That consolidation encourages traders to take a early sell. So let's say retail traders sell here, price retraces back, break of structure to the upside, so this will be a stop hunt, and a break of structure to the downside, so this will be their break of structure, and they sell here, and even get in another sell right here. Just for price to do what? Take out their stop losses. Once price takes out their stop losses, goes to the initial area where price intended to go to and continue the downtrend. So what happens during an inducement? Liquidity will be built via retail trader stop losses and false breakout for scalpers who dominate majority of the trading in the retail world, due to not being patient and wanting quick results. This prints on the chart as a liquidity grab, where the stop hunt takes out the stops and proceeds to the level institutions intended to buy or sell at. So the other function of an inducement is not only that it's a reversal point where the market is tricking you into taking an early position, there's also buyers in this market and traders that take a buy position once price breaks this level, thinking price is going to continue to the upside. So here's an example. You can see this is your point of interest. Price forms a fake swing nearby your point of interest to induce traders. And not only that, there's multiple deceptions here. You have a bullish order block right here. And price is trying to induce traders into taking a bullish order block entry as well, not knowing that this is the intended point of interest. Just for price to take all the traders that purchase price here out, and also fake any sellers that are trying to sell the market. So let's talk about inducement criteria. The most important thing when identifying true inducement is that it occurs at fair price. Price going to fair pricing to balance books and keeping options open is key to an inducement. So before reacting from price extremes, expect an inducement at fair price or nearby. So here's an example. Your point of interest is always in the extremes, and here's the top of your range. As you can see, around fair pricing, which is in the middle, price engineered liquidity, trying to induce traders into taking a long position, just to eventually go to your discounted area, which is your discount demand, and continue to the upside. And this is how it looks without the fib. So you had your liquidity being engineered right here. Price comes down, stop hunts right at your point of interest and expands. So in this example, our operating time range when it comes to the macro is our 8-hour. And what is happening on our macro? Price broke structure. So the first thing you do, just how I explained in the first part of the Price Pro mini course, is locate your range. And if you want to learn more about operating time ranges, make sure you visit the website and use code PRICEPRO for 20% off. So now let's go on our micro. See where we can locate a micro range. So what are we waiting for? We're waiting for a price to come back inside of the range because it's one of two scenarios, right? It's either price goes on an expansive move, which could be a sequence of multiple candles going to the upside, or price comes back in the range. Now, if price does expand aggressively, you are looking at a support and resistance structure. But if price does come back quickly back inside of the range, then you are looking for a supply and demand structure. So now price came back inside of the range. So what do you do next? You pull out your fib, and you mark your discount zone. So this would be our discount zone. So now that we have our discount zone, let's mark our fair price. So what is our fair price? Is this middle area, just how I explained in the first part. So there's two ways you could mark your fair price. You could always do it with a line, or another solution for a broader reach would be a zone. Because like I said previously, when it comes to your fair price, you want that inducement to occur at your fair price or around it. So you would mark up this entire area, somewhere in the middle of both. So now what do we expect to happen? We expect price to come back to the discount, right? We expect price to come back down here. But for us to take any entry or look at any directional buys, we need that inducement. We need traders to be tricked out. So we would need a little bit of a consolidation in our fair price, and for price to come down and go to the price that's intended. What's the purpose of this? The purpose of this is to trap the seller. So anybody that wants to sell price beneath this level, thinking price is going to continue to the downside, just for price to reverse on them right here. Or it's also to induce traders to take a long position. So as you can see, you would have a aggressive move to the upside. In that retracement, a lot of traders would think price now is already back inside of the range and price is going to continue. And the safest option is always to wait for your discount. Why? Because it's cheaper to buy discount. Buy low, sell high. Common sense, right, guys? So let's play out price. So this is our inducement. And look what price is doing here. Now, again, price could just shoot up. Price could have just went outside of the range and came back inside and used the fair price. Like we explained in the first part, But when it came to our shirt example, you can purchase a shirt at fair price and that'll be a fair deal. But if you want to make profit on it, you would have to purchase it lower. So by that sense, price could have just came here just to continue the bullish trend. That happens a lot of times in the market because nothing in the market is for certain. Price could never reach your discount, and this does happen a lot of times. But this is the safest approach. But in this case, you can see the price came to the fair value price, and formed a swing high, came back down again, which would be a retracement back to the discount level. Again, let me make this clear. You had an expansion right here to the upside, and you had a retracement back to a bullish order block, right? A bullish discounted order block of this range. Sure, I don't need to over explain it, but a discounted entry right here on our micro, right? And the purpose of this entire thing is to induce traders into taking a long position. I mean, obviously, on the micro time frames, especially for scalpers, and we know scalpers dominate majority of the trading in the market, you would anticipate a lot of entries, smart money entries right here, a lot of breakout entries a little bit higher right here, and so on. So traders are being induced to take a long position just for price to do what? Continue inducing them, and boom, price come down here, go to the discount level, and continue the bullish trend. So again, price accumulated, manipulated, and distributed. So let's look at another example. Let's mark up the range of our macro. This is our swing high right here and our swing low. And if price comes back on the range, back inside of this range, we can confirm this range. So now let's go to the micro. Let's see if price does come back inside of the range. So now price came back inside of the range. So now this is your high. You pull out your fib. You mark your fair price and you mark your discount. You're looking for your inducement, and here was your inducement. As you can see, price was calm right here, went into a consolidation and gave you a fake signal to the upside, trying to induce you into taking a long position. And how are they going to induce you by taking a long position? Obviously, there's two ways. You got the retail method and you have your smart money method. The smart money method would be something like this. Would be a retracement back right here into a deep, more than likely a 15-minute order block somewhere right here. This would be the entry for your smart money traders, and this breakout right here would be the entry for your retail traders. So this would be one entry, and this would be second entry. But we know the price is really targeting the macro levels. Why? Because macro is king, higher time frame is king, and price will more than likely take out this level, destroy these traders, and go for the level they actually intended. This is all a part of the inducement. Liquidity was engineered right here. This was your stop hunt. Was your liquidity right here. This was your stop hunt. And this was your point of interest. So here you have your supply and demand structure. So where do you expect price to go next? You expect price to go back inside of the range. And once price comes back inside of the range, what's the next destination? Back to your discount, which in this case would be your demand zone. So when you go into lower time frames, you will see the consecutive micro swings. Now, once price approaches your demand zone, you can expect a reversal point, which would be your consolidation. So let's look at how we would trade counter trend if we are scalpers. So let's say that on the macro here, you can mark up your high and low. Obviously, you would go through the exact same process. You would mark your high and you would mark your low. Now let's go on the micro. So what do we expect? Like we said, it's only two options. It's either an aggressive expansion or a retracement back inside of the range. So now, if price comes back inside of the range, you can confirm the new range. And once you confirm your new range, what you can do is you can trade all the way. So let's first confirm if price comes back inside of the range. Okay, so now what you could do is you can mark your new range, apply your fib, and you got to understand, you are in a bearish trend. So the highest probability here is for you obviously to get your inducement right here and then to get in a sell right here. And as far as entry methods, because there is a confirmation process that you should go through when price does reach your extreme point, and we'll cover that in part 3. But as far as counter trading, which is going bullish in a bearish market as a scalper on the lower time frames, if you know that price will reverse right here, or more than likely, obviously more than likely to reverse right here, and you're more than likely to get an inducement right here, then your highest probability as far as counter trading would be from once price comes back inside of the range. So let's say price comes back inside of the range here. From this point, from this extreme, which is your discount, and you release right here. This is the highest probability. Again, we're following the exact same rules. We're still buying in discount, even though it's counter trend. So the highest probability would be buying in discount. Taking price from this level to this level. And I explained this deeply on our website. So this would be the highest probability trade. Now, another way you can trade it is to wait for the inducement and take a breakout of the inducement and take price up to here. But now this is a less probable trade. The highest probability in a counter trend is right here. And again, a counter trend can never be as high of a probability trade as going along with the trend, which is obviously selling in premium. Why? Because the entire trend is bearish. So taking any pullback back to your return to origin, which your return to origin would be right here. And if you zoom in, this is your range. So any retracement, which you're currently going through right now, you can take a entry up to this point. This will be the highest probability trade when it comes to counter trending. And this is if you are a scalper. So this would be the easiest going. And as you can see, a lot of times If you understand the ETM concepts, you understand that this is clean traffic. There's no resistance right here. So this will be easy to fill up. And if you go back in your back testing and you look through previous historical data, you would see that a lot of times in these areas, price will be clean traffic. So now, let's say you want to take another entry as a scalper. Now, the probabilities are less, but if you are to take a trade, you would wait for your inducement session to occur and to take a continuation trade based off a breakout. Take it right to the extreme. So what is price doing? Price tried to induce traders into taking a low position. So now, see this peak right here? Once you get a breakout above this level of rejection, where price trying to induce you multiple times into taking a low position, a short position, you can take a breakout right above. But I'm not a fan of taking a buy at fair price just for the simple fact that your risk to reward will more than likely be a negative risk to reward and your probabilities are a bit lower. Why? Because you're really trying to buy price really close to your premium. And like we said previously, price could always reverse in your fair price. As you can see, the breakout happened, price reached your premium, and now what do you expect? You expect price to continue with the trend, which is bearish. Hope you guys enjoyed this lesson. Please make sure you like, share, and subscribe, and make sure you leave a comment. And let us know if you want part 3.